Hey Dave, how you doing today?
Not bad, Nick. How are you?
Doing well.
Good.
Snowing and Michigan spring, but
Yep.
we have I think I saw 67 on the calendar, so better days ahead.
Yeah. That's
Keep
March in Michigan. You can turn up the heat and turn down the heat in the same day and not be
exactly.
surprised. And and sometimes it's not in the order you'd expect. So
That's very true.
love it, love it.
So we have I don't know if exciting is the word that I would use, but definitely a timely podcast about kind of some stuff of what's going on with the markets, what's going on,
Yeah.
how Russia and the Ukraine conflict is affecting the markets. And we just wanted to kind of take some time today, touch base on our thoughts on that, and then what you should be doing proactively.
The snowblower's out. Hold on.
You're fine. No worries.
He was asleep, and then the snowblower started. All right.
No worries. So I will pick it up from there. So, and then we will end kind of with what steps you should be taking, what you should be thinking about as it relates to your personal financial plan.
Yeah. So kind of like Michigan weather in spring, we're seeing the market bounce all over the place with the news. And as of uh, as of this morning, the general market, as measured by the S&P 500, is down a little over 10% from January 1st. And so we're in what's called correction territory, and that's anytime the market's down 10% or more from its peak. Um, and it's interesting because the market goes through these kind of cycles, and it's fairly normal. But I think the nature of an actual military conflict amongst some pretty important European countries kind of captures everybody's attention a little bit differently than other events that can cause these kind of market turbulences. Um, and coming coupled at a time when we're also dealing with a lot of inflation at home already, and the main impact other than market movement on Americans is price of gas at the gas pump, and that being inflationary as well kind of catches everybody's attention right now.
Yeah, absolutely. Just a lot of stuff going on, a lot of stuff that we don't know exactly what the long
Yeah.
lasting what the long lasting effects will be, but certainly a lot of fear in the market, and we're seeing the market bounce around. And one of the things that we like to do, I know that you and I talked about this a couple weeks ago, Dave, was one of the best things you can do when you want to kind of understand is go back and see what's happened previously when we've had
Yeah.
conflicts. Now
Yeah.
every conflict and everything's a little bit different, but it at least helps
Right.
us put it into perspective of kind of what to expect.
Right. Yeah. And our the general nature of these kind of events and the markets is that the market has a lot of instability while the event is going on, but tends to recover fairly quickly. Or even if it doesn't recover, it at least reverts to what it was doing before the event, because the event doesn't usually impact macroeconomics and the true drivers of the market in the long run. So, our Vanguard provided a really nice chart that we've stolen and posted on our website, but it kind of summarizes some of these events. And it's interesting because during the initial, after the initial downturn from an event like this, the average market return after 6 months is plus 5%. And the average market return a year later has usually been plus 9% on average. And looking at some specific examples, one that I think maybe fits a little bit better than some of the others is the Iraq War in 2003. Market was down, initially as there was fear of what the global impact would be, but 6 months later it was plus 19%, and 12 months later it was plus 27%. Um, the Ukraine conflict in 2014, the market was plus 8%. 6 months later, plus 12% 12 months later. And I'm not predicting that we're going to have those kind of outsized returns, but the point is that, the initial impact was kind of scary and turbulent, but the long term impact on the economy wasn't that big a deal.
Yeah, and I think that's the important lesson here because when you think of it, if you have a market downturn like we have, the initial reaction is, well, I should sell and get out of the market. And the reality is, usually that stuff comes back pretty quickly. And if you
Right.
sell and get out, then you miss making that money back
Yeah.
up. And then you get into this whole ordeal of, can I time it right for when it's going to go back up? And,
Yeah.
nobody's been able to successfully do that. And so, it's not only when to get out, but also when to get back in. And that, is
Right.
extremely hard to do.
Right, right. And, just the last 3 weeks, we've had 2 day in the midst of what's generally a down market. We've had 2 days where the markets were up over 2%, almost 3%, depending on which index you wanted to look at, mixed in there. So, you'll drive yourself crazy trying to pick the right day to get in, the right day to get out. It's never going to feel good. It's never going to feel right. You're better off just sitting down and grab both hands of the both sides of the lifeboat with your hands and just stay put. And it's not easy, but that's 99% of the time the right answer.
Yeah, so it's always interesting. It's nobody wants to lose money in investing, and nobody likes to come in and see that their portfolio's down 4, 5, 6, 7, creeping up on 8, 9, ten
Yeah.
percent. However, one of the things that we've been walking through clients with as well is, if you pull up how well we did last year, we haven't even
Mm-hmm.
given back all of those gains of
No.
2021. So that at
Yeah.
least makes you
Yes.
feel a little bit better.
Yeah. Yeah.
So I know that's another strategy that we've been kind of bringing up with clients.
Yeah.
But nobody likes to lose money per se, but
Yeah.
that just goes back to that philosophy of you haven't really lost it until you sell. And so if you hold
Yeah.
on and it comes back, you should be made whole in some
Yeah.
short amount of time.
So while you were talking there, I just pulled up a chart of the S&P 500 for the last 3 years, which I think is a great little microcosm here because that's going to include this current downturn, but also includes what happened in March of 2020. Okay, so we've got some pretty scary times mixed in there. And if you just held and did nothing, and if you just bought the S&P 500 in March of 2019 and held it through today, you'd have a cumulative return positive of 63% over that time. And that works out to 10.4% annualized. So that the point of that isn't to diminish, what we're going through right now. It's to remind everybody, 10% downturns in the S&P 500 happen all the time, frequently. I believe I should pull out my copy of the Stock Traders Almanac, but I want to say the statistics are on average over the life of the market about once every 24 months, 18 to 24 months. It's somewhere in there. We have a 10% pullback, and then the market marches on. And we've got a great chart on our website from the blog article we did on this same topic a few days ago that shows, nothing new. Most people have seen this chart, but it's the stock market since the Great Depression. And what you see is that, the statistics as of Monday when we posted this were that $1,000 invested in 1928 would be worth almost $250,000 through, now. And along the way, you dealt with 1970s stagflation markets, Black Monday, the tech crash, the financial crisis, the Vietnam War, the Cuban Missile Crisis, you name it. There was never like this magical time when there was nothing to worry about. But if you just held through all of that, everything continues on.
Yeah, it's interesting because those are some, serious major events, and when you are in them and experiencing them, they
Mm-hmm.
feel a whole lot different than when you give yourself 5, 10, and some of those, 15, 20, 25 years
Mm-hmm.
between them.
Mm-hmm.
It's interesting because I read an article in the Wall Street Journal the other day just about, COVID and how we're going to forget most of it.
Right.
And so, when we were living in it, when we were the height of 2020 and,
Sure.
everything shut down, it was this crazy event. And, now, even now we kind of feel like, okay, that was fine. That wasn't that big of a deal. Right? I mean,
Well, yeah, it's a trick of the human brain that what you've lived through couldn't have been as bad as you imagined it was going to be, right?
right.
And so here we are looking forward, and everything's scary and unknown and seems worse than things we've gone through in the past. But if because yeah, we tend to have selective memories and just filter everything through the fact that it couldn't have been as bad as we thought because we lived through it. And I think I brought this example up in other contexts before, but I think of my grandpa's stories about the Great Depression, and what he remembers from that is how close his sisters and he were because they had to help each other through that.
Hmm.
But he doesn't remember or doesn't have the same like scary sense, even though he didn't wouldn't downplay how worried they were about where their next meal might come from. It wasn't the way he remembered it. Wasn't the important part, if you will.
Yeah.
So that's just part of human psychology, and behavioral uh, finance experts will back that up. That we just tend to sanitize things in the past and worry more about the future than we should.
Yeah, absolutely. And it's kind of to bring that around to how that relates to investing is when you're in it and you have those emotions, if you make changes or do things, that's when you can really harm yourself. And so some of the best advice is also the simplest, which is to just continue doing what you're
Yeah,
doing.
yeah,
But it's also some of the hardest to implement.
yeah. Well, and we tell people this all the time, but we didn't build any client portfolio expecting things like this weren't going to happen. We
Hmm.
may not know the headlines, but we know that if you have 3 years in a row of 20% plus returns on the general stock market, you're going to have 10% setbacks. That's just the way the market works. And we didn't design anybody's portfolio thinking that's not going to be the case. You've got to step back and remember why you hold some safe assets in the mix and why you're diversified, and remind yourself that the definition of investing is to take short-term risk with the hope of long-term gain.
Yeah, absolutely. It's kind of, almost, the cost of doing business, if you will, when it
Mm-hmm.
comes to investing,
Yeah.
where, those things are going to happen, and how to prevent them isn't doing things now. It was really probably doing things 6 months or a year ago, or whenever you set up
Right.
your portfolio. And we've talked on this podcast before about, having an investment philosophy and sticking to it. And that's one of the big things. We
Yeah.
believe in long term of investing and not to make decisions based on what's going on in the short term. And there's no further proof than kind of what we're going through right now.
Right. Right. You know, and just part of that is knowing that the market's already accounting for everything that we know. So anything that we're doing is just guessing whether the market's priced everything in correctly. We can guess that things are going to get better, or we can guess that things are going to get worse, but we're really just guessing. And by the time it's reality and by the time it's in the news, the market will have moved before we've read the headlines. And that's true of anybody.
Yeah, it's amazing how fast and efficient the market is these days with information. And some of this stuff I'm sure was already somewhat priced in, maybe not to the degree, but there was,
Mm-hmm.
before the conflict even happened, because of because it might have happened. And
Right.
it's just one of those things, like we talked about. It's easy to talk about, it's hard to live through and do. And so if you're
Hmm.
worried, if you're thinking about things like that, you're just know that you're not alone. We may make it sound easy, but I guarantee you, with the clients that we've had and our own emotions involved in some of this stuff,
Right.
we both kind of lived through 2008. We're in the business, and had days when we definitely questioned. I know I had days when I questioned my own sanity about,
Yeah.
is this
Yeah.
thing really going to come back? And that's just part of the bargain.
Right. Right. And we'll just have to see how it plays out. And you know, we're not, you know, we're not saying don't do anything because we're indifferent. We're saying it because it's almost always the right thing. And um, this time, despite the imaginative headlines, that of a actual firefight, hot war in Europe, um, it's not necessarily different from a macroeconomic standpoint, and we just need to keep that context in mind. We've got along those lines, about 3 years ago, I got tired of writing the same stuff over and over again for the same kind of situation. And so we actually compiled all of those articles that we had done in the past into a booklet that we call the Market Volatility Survival Guide. And, I looking back on it, it's, some of the examples are so far back in memory that they seem a little hokey, but, you know, the same premises hold true.
Yeah, absolutely. It's funny. A lot of the things change, but the general principles are still the same when it comes to a
Yeah.
lot of this stuff. And, for people who maybe haven't been investing this that long, maybe this is one of the first times they've experienced. And even for people who have been investing for a long time, it's always, different stages of your life, you'll react differently to these things. And I
Hmm.
think sometimes people forget that, if you're in your 20s and 30s and your whole goal is to grow as much money as you can, this isn't necessarily going to register as far as like, well, my
No.
401k is taking losses, because
Right.
you're so far removed from needing that. And to some degree, I would argue it's kind of a good thing, because you're continually putting money in and getting
Yes.
more shares for the same thing you were buying, last month. So
Yeah.
volatility is actually kind of a good thing in that realm. But
Yeah.
the flip side of that is, if you're all of a sudden in your late 50s and now you're thinking about retirement, and now we're having one of these events, it's a whole different mindset than when you were 30 and you were just looking for
Right.
growth.
Well, right, but your portfolio should also have evolved along the way too, so that you're not putting yourself in a bad position the way, your 30-year-old portfolio might have had too much volatility for your 50-year-old portfolio. So, that's part of the strategy too, that has nothing to do with what the market's doing on a day-to-day basis, just the natural evolution of where you're at in life and how your finances should adjust. Part of that, though, maybe the next place to go with this conversation is to talk about a few proactive things that you can do during times like this, that don't involve selling all your stock holdings.
Hmm.
Instead, quite the opposite. Like you said, in your 401k, this might be one of those times that's an opportunity. And if you're in saver mode rather than spending mode, if you can increase your 401k or increase your IRA contributions or your Roth IRA contributions in a time like this, that can pay off, because you're buying the market when it's less expensive, and the market will bounce back as the risk changes. So take advantage of that. The other thing that we do is regularly rebalance client portfolios. And so if you're not adding to your portfolio, one way to take advantage of the volatility is to rebalance, which means moving back to your target allocations. We've talked about this many times in the past, but if you just imagine two investments in your portfolio, stocks and bonds, and say in January you set them at 50% each, and the stock market's dropped and the bond market's pretty much stayed put, you might be at 45% stock now and 55% bonds. Go ahead and shuffle some money from bonds to stocks back to bring yourself back to those targets. And you're
Mhm.
effectively buying low and selling high.
Yeah, absolutely. Great suggestions there, and this it comes down to coming back to just having a well balanced overall personal
Mm-hmm.
financial plan. And we made it 20 minutes, Dave, but if you
Here it comes.
if you have an emergency fund and you have cash set aside, this is a great time, because if you don't, or if you aren't relying on taking money out of investments, or even if you are but you have an emergency fund and you can kind of peel back some of that, or maybe not take that trip, or there's a lot of different personal things that you can do. But
Yeah,
the work needed to be done 2, 3, 4, 5 years ago to
right,
get yourself in that position of being solid, not needing to take money out
right,
of the investments when other than normal distributions, having that emergency fund,
right.
having extra cash. Those are all things that if you did previously, you're in a pretty good spot. And if you
Yeah,
haven't, now's the time to start thinking about how do we set those things up.
yeah. And to kind of bring that home, what's one of the first things we ask a client in a meeting? What do you foresee spending needs for the next, 18 to 36 months? And where do where's that money coming from? And do we need to, think about that in terms of the portfolio? Because we're not going to know in the short run. We need to think strategically ahead of time. A couple other proactive things you can do. If you have an after tax account, you can always look and see if there are things you can sell at a loss and replace with other similar investments so that you can offset gains later on, tax loss harvesting. Um, it We're not there yet, but if in extreme, when the market gets extremely oversold, if you're planning to do a Roth conversion during the year, that's a good time to consider doing that because you'd like to have the recovery happen in the Roth. And those are other things we can talk about and help clients with.
Yeah, more great suggestions. And it really does. It's funny because the last couple of years we've had conversations with people about hey, I want to. We have plans to, put a money down on a house, down payment, things like that, and where we're
Mm-hmm.
actively telling people, you don't want to invest that because you never know what's going to happen, and that's a hard thing to
Mm-hmm.
swallow when the market's going up. But I'm
Mm-hmm.
sure today they're grateful that they kept that in cash, and maybe they didn't earn anything, but certainly better than being down 10% right now. And
Right.
so,
Right. And not being
some of
able to do
those
the kinds
decisions
of
as well,
things.
holding cash might not feel great in this low interest rate environment until all of a sudden it does.
Right.
Um,
Right. Right.
so one other thing too I wanted to bring up, Dave, is we talked a lot about don't hold, keep doing what you're doing, don't make any drastic changes because of the short term. But I know you and I have both walked people through when they had to, when you were losing sleep over what's going on in your portfolio and you really just can't stand it. There are things that you can think about doing as kind of a last case scenario. And you certainly don't want to be in a mindset where your health is deteriorating and you're losing sleep over what's
Right.
going on in your investments.
Right. Right. Yeah. It's not worth it to really hazard. I guess that speaks to were you in the right place in the originally. You know,
Mm-hmm.
and so what do we do in those situations?
Yeah, I mean, you have to be comfortable, and you have to figure out where your comfort level lies. I mean, obviously your health
Yeah.
is more important than your investment return. So if that means taking some portion of your investments and putting it into cash until you are in a better spot, helping people to figure out what that amount is where they feel good about, and
Yeah.
helping facilitate that. And then once things kind of get back to a normal or you're feeling better, then you have that conversation of, okay, let's think about where maybe I should have been in before so I wasn't
Right.
in panic mode. And then how
Right.
do we kind of get you back to that point strategically?
Yeah. And it's we don't want to see it come to that if we can prevent it. But we say it a lot, but we don't usually change strategies based on the market. We change strategies based on client needs.
Mm.
And so, when we're having those conversations, my goal would be to try to get folks comfortable with staying put as long as their needs are being met.
Yeah.
Um, but you're absolutely right. If you're hazarding your mental health over it, then we do need to do something, and we will.
Yeah, it's one of those situations we talk about it a lot on this podcast. Is it the right thing to do financially based on the
Yes.
numbers? No.
Yeah.
But is there occasionally a good reason for it? Yes. And so, don't
Yeah.
feel like you have to soldier on, but you haven't gotten any sleep in the last 2 weeks. I mean,
Yeah.
that's not a good situation either. And so, at some point you have to be practical about that kind of stuff.
Right. Right. And um, the truth with asset allocation is usually somewhere in the middle. It's not one extreme or the other. And you shouldn't be all in cash, and you shouldn't be all in stock for most people. So,
Hmm.
you know, but when we talk to people that haven't worked to intentionally build a plan, we do see a lot of the extremes. And so I guess maybe to close things out, if you haven't done that kind of legwork before on your finances, this is a this is a good time to do it. Talk to a professional, get some help, figure out what kind of asset allocation makes sense for you. And we talk about the two different factors there. One is your mental health and what can you stomach, and the other is what kind of returns and risks you need to take to make your plan work. And those can often be very different. But if the risk tolerance is low, then and you would technically need to make more, then we need to look at other things like, can you save more? Can you spend less? What are the other levers we can pull? So that's bringing it back around to what really matters is the financial planning part is what really matters. The markets will take care of themselves over time.
Yeah, I think that's a great point. If you're just looking at it from the standpoint of, what your investments are and what they're gaining and losing, if there's no
Hmm.
real, plan behind that, that's, I think, a lot of times when people get into trouble, right? So if you have a
Right.
plan and like the purpose of these investments and the returns that you need to get and how that's going to allow you to be successful, and we talk about it all the time, what that means as far as making sure you're living your best life and doing the things that you want to do, that's a different conversation than just looking at a portfolio that's down 10 or 15% and going, what do I do now?
Right.
It's because it
Right.
has a purpose behind it. And one of the
Right.
things that we like to do when it comes to times like this is we'll pull up the plan and we'll look at where you're at right now, even though the market's down, and then we can even do some what if scenarios of what if the market goes down
Right.
another 10 or 15 or 20%. How does that affect your ability to do all these things that you told us are so important to you? And a lot of times I think people are surprised that it doesn't really affect their ability
Yes.
to do those things, which
Yeah.
allows them to kind of stick with the plan much better than if we were just to say, hey, your portfolio's down 10%, you lost this much money,
Yeah.
don't worry about it.
Yeah. Yeah. Right. And to that point, we're in the middle of spring client reviews right now. I've pulled up in the last 10 working days anyway, a dozen, probably 15 different plans with clients. In the midst of all this, not one plan that we've looked at is really affected in terms of what we expect its outcome to be based on what's happened right now. And no financial planner built a plan thinking, boy, this would all work as long as we don't have a 10% downturn for a few months at some point.
Right. Exactly.
So,
Yeah.
but when you're not doing this every day, you lose sight of that. So, I'm not surprised when clients expect the impact's going to have been higher than it is, and it's always a little bit rewarding to show them that,
Yeah.
hey,
Right.
your plan hasn't changed, and we're still fine. We can still pay the bills and do the gifting you wanted to do or whatever that strategy is, and this it's not great, but we don't like to go through these things, but we expect it. It's part of the game.
Yeah. Yeah.
So
Absolutely. So true. So, as always, if you have questions about the market or your portfolios or what's going on, we would love your questions. You can email us at info@srbadvisors.com. We're going to plug these charts into the show notes today, as along with our market volatility survival guide. So if you're interested in checking those out, check out our website and the show notes for this episode. And with that, Dave, I bid you farewell and a great weekend.
Have a great day. Thanks, Nick.